In terms of the FY19 results, the company delivered a full year result above the top end of guidance for our non-network business at $450 million, excluding redundancies. While the group EBIT result of $829 million was 12% lower than prior year, it reflects the impact of the UT5 final decision in network, which includes a $60 million true-up owing to customers in relation to the previous year. It also includes a $20 million recovery of doubtful debt. So what I want to do is spend the rest of the time talking about the slide in front of you. It looks at Aurizon's key achievements since I joined the organisation in December of 2016. So much simpler company these days. Lots been done to get us there. And so what I'll do is talk through a bit about what we've done. Started with the business unit structure, and this included putting in place a refreshed management team. The move to the business unit structure was all about driving accountability for results and a more close relationship with the customer. And also that led to stronger service delivery expectations for each of the businesses. Then moving on, we executed a freight review. The freight review had started before I joined the business. It led to the exiting of the intermodal business, which, to remind people, the exit of the intermodal business included the closure of the interstate intermodal business unit in December of 2017, the sale of the Queensland intermodal business unit to Linfox in January of 2019. The last part of the exit of the intermodal business is the sale of the Acacia Ridge terminal. We had a court decision which was supported the sale of that terminal, but the ACCC has appealed the decision. The second part of the freight review led to the establishment of the bulk business. Was all about turning around the bulk business. Our turnaround is a multi-year program, 3+ years, and currently halfway through that time, we're actually in line with our expectations. We had a couple of contracting wins through the period, which included a new contract with Glencore and the Linfox contract itself. We do expect continued EBIT growth for the business into FY20 on the back of new contracts and ongoing operational efficiencies. FY19 was a big year for the network business. It saw the delivery of an annual record volume of 233 million tonnes delivered for the year, and also the 10-year commercial deal with the customers for UT5, which sees the WACC increase from 5.7% under the final decision by the regulator to 6.3% as part of the commercial deal. There are some, that is subject to a number of commercial or certain milestones being achieved. The quid pro quo for the increase in the WACC was that the customers want to see a number of things, which include an independent network capacity analysis, enhanced supply chain coordination, and involvement in the maintenance and asset renewal process. Operational efficiency remains a key focus for our business, and since listing a decade ago, Aurizon has made significant changes to the business, transforming from a government-owned corporation into a much leaner, more efficient organisation. But in saying that, there's still a lot more to do. Efficiency gains for Aurizon feature heavily in our forward plans for the next decade. Talking about the coal business unit, volumes were up 1% to a record 214 million tonnes in FY19. There were two significant contract announcements made last week for our Queensland portfolio, the first being for Jellinbah, where we recontracted new agreements to exclusively haul over 15 million tonnes for the Jellinbah East and Lake Vermont mines. And then the second company that we announced contracts with was with Glencore. That was for a range of contract extensions and additional volumes, heavily weighted to the Newlands corridor, if anyone likes that sort of detail. The useful part of both of those contract announcements is they highlight that we're de-risking our contract book as we move forward. We expect EBIT growth for FY20 for the coal business that will be driven again, like bulk, by volume growth and operational efficiencies. Also completed two major reviews during FY19. The first was a legal and capital structure review, and we are now in the process of implementing against those outcomes. And essentially what you'll see there is the above rail and below rail businesses move from a vertical alignment to one where they're actually operations and network are actually separated. What that does is it allows us to add, for the same credit rating, an additional funding capacity of $1.2 billion of debt, which we will introduce progressively over time. It's probably important at this point I pause and talk about our capital allocation strategy. The way we allocate capital is first for non-growth capital, obviously sustaining the business, second to dividends to the shareholders, and then finally any surplus capital we look to return to the shareholders or deploy to growth projects, and only where it maximises shareholder value. So the additional funding capacity will be, as I said, progressively over time deployed against that strategy. So in the absence of growth, this provides the opportunity for additional capital management over a number of years. The second review we completed during the year was the review of whether the decision to take the business out of government ownership as a vertically integrated business and keep it that way was still a sensible decision to stick to 10 years on. And we looked at a number of issues, actually through a number of lenses to make that decision. We looked at what a number of the stakeholder groups, shareholders, customers, community, government, etc., thought was important. We looked at the synergy opportunities or dis-synergy that would come from making that a separation decision. We looked at how it's being integrated or not supported growth options. We then looked at obviously valuation and capital structure. The clear evidence that came out of that work was that remaining integrated was the right decision for Aurizon at this time. So after all that work through the year, what does that mean for the shareholders? We declared a final dividend of 12.4 cents per share. That's franked to 70%, and it represents another 100% payout. It equates to a total dividend of 23.8 cents per share. And also announced an on-market buyback of $300 million to be completed in FY20. And as I outlined above, the additional funding capacity of $1.2 billion that was unlocked as part of the legal and capital restructure provides an opportunity for further capital management over time.